It's a well-known fact that sentiment drives returns in the short term. This has been no exception when we look at asset manager returns for the first half of 2012. Joining us, as I said, tonight is David O'Leary from Morningstar South Africa, a fund and company research business, also now present here in South Africa. Now, if you'd like to know more about the methodologies utilized by Morningstar, please do visit our website, abndigital.com, and you can see what David's views were on the methodologies that Morningstar uses to research the information that we'll be taking a look at tonight. So let's get straight into it and take a look at some of the returns that we have seen for the first half of the year. Roland, your thoughts on quarter two and how that's translated into the first half performance. Property sector once again a shining star, and bonds just continue to outperform.
Yeah, we've had a very interesting first half. The first quarter was probably dominated by quite a bit of that's South African strength and European weakness. We probably had about a 5% return in that section, and then we had the rand weakening substantially, and we've now in the second quarter also had a bond and property run, retailers keeping going, and that's supported to some extent the equity market, but it's been quite a soggy second half of the first half, if you know what I mean.
Yeah, things just seem to have gotten a lot worse, or certainly in the economic data that has started to come through from the United States. It seems that the economy isn't doing as well as we hoped it would at the beginning of the year. China, of course, slowing down. Europe's problems still unresolved. Kwebi, your thoughts on how this is translated into various returns from the key sectors?
Yeah, I want to say a little bit more about what Roland said just now, because if you're going to make decisions about investment matters at the moment, and you're going to do it from a fear-based point, hence you've lived through 2008, you've had a really, really tough time, and now you're trying to make some fear-based decisions. You're not necessarily going to make the right decisions, and we've seen a lot of that in kind of quarter two, when you've looked at some, if you looked at the returns for kind of the big sectors. Just have a look at the table that's on your screen at the moment, and you'll see there's the big drivers for returns over the second quarter. There you can see domestic real estate, general in South Africa, up 8.9% for the quarter. Foreign fixed income or bond up 5.8%, and domestic fixed income here and bonds in South Africa up 4.8%, squeezing those yields all the way down to kind of very low single-digit levels. And then if we look at the worst performing categories, over the second quarter, there you can see it. Domestic equities, resources, led by the platinum miners, very, very tough time for them at the moment. World equity technology, which is obviously international, and then domestic equity managers or value, what we call the value category, having not really done that great. And that's what I'm saying. If you're going to make a decision on sentiment, you're probably going to make the wrong decision by investing, by just looking at the very short term.
And certainly if you're going to make a decision on the short term, you're not going to make the right decision. But of course, it's good to look at the numbers, and that's how we rate fund managers, and that's what we tend to do. David, let's bring you into the conversation right now. Firstly, have you been taken by surprise at all by the best performing categories and worst performing categories so far this year?
No, I think there are two things that drive the market: fear and greed. And right now we're just in an environment, and we have been for quite some time, where fear is the dominant emotion driving the markets. And so you'll see it ebb and flow with sort of every news break, where where slightly positive news comes out and the market overreacts on the upside, and same on the downside. But overwhelmingly, it's sort of consistently fear-driven. So to see more conservative assets do well is not at all surprising to me. It struck me today. I was sort of looking at the numbers, and we're sort of 5 years into this sort of post-financial collapse market. It's late 2007 that it first started, which was, sort of took me aback that it was, we're already 5 years into this. But I think investors are getting very, sort of tired of all of this uncertainty, and their ability to control their emotions probably is is wearing out. So you're seeing a lot of volatility.
Fatigue certainly is the word, especially if you're talking about the Eurozone crisis. I mean, every day we come up, there's a new story hitting the headlines, and of course driving market sentiment on the day. How do you take a step back from all of this and evaluate where to put your money right now?
Well, I think you gotta look at longer term periods in order to actually make decisions about capital. And I think maybe what we should do is we should maybe do a little bit about that, a little bit of that at this stage. Maybe just have a look quickly at that table, and there's the year-to-date numbers. You can see domestic real estate there, okay, continuously doing fantastically well, 16.5%. Financials 14.7, and then smaller companies at 13.2. And as a matter of fact, let me then increase the holding period and kind of show you year to date kind of what has happened just from a graphic perspective. There you can see listed property in the dark blue line. You can kind of see where that ended the year to date relative to financials. You can see the dip there. That's on the back end of some profit warnings, especially from ABSA, and potentially some other ones could potentially come into the fall there as well. And then you can see the small cap index. You can see kind of where that is ended. We're going to extend that periods a little bit later on to kind of just look at decade type returns, because that could be quite interesting. And maybe just as another point, maybe just to kind of think about, look at the table that's on your screen now. Those are year-to-date numbers, and these are now the worst performing categories. And there you can see it. Resources, year-to-date, terrible, minus 7.3. Money market, 2.7 was what you would expect for money market. And then foreign fixed income bond, up at 3%. And let me just put that for you into graphic terms, and there you can see it. No surprises. There's a Steffi Composite Index, which is a proxy for cash. You can see kind of the performance for that. But look at resources. Look how fantastically badly resources has done over the period. Most of those are kind of in single-digit territories. Billiton, Anglo,
yep,
kind of in those areas.
They are at, in terms of valuations, at one of the lowest levels they've been for a long time. So how long this will last for obviously will depend on the whole global growth scenario if that recovers. But they certainly, from a long-term perspective, cheaper than you'll probably get them going forward.
But what if earnings continue to come back, and then those PEs...
That is the global growth scenario.
Re-rate.
I mean, it is our view as a group that in the second half of this year we should see some commodity prices surprising again on the upside. The oil price is already above, hovering around $110 again. So we could certainly see a bit of a rally in resources, but that's a very short-term kind of effect.
David, with resources having fallen by, the resources sector having fallen by around 7% year to date, is it time now to be getting into resources? What are your thoughts on that?
Well, to be honest, I mean, I certainly don't have any strong convictions on that. That's not my area of expertise. I mean, I think, there are cases that could be made on either side. I think, when there's big swings like this, there are opportunities to trade around it. But that's certainly just not my expertise.
Yeah. Well, let's talk about then the other end of the spectrum. Of course, the property sector continues to outperform. So too does the bond market. We've seen a surprise rate cut here in South Africa for the first time in a while. And of course, that's a trend we're seeing across the world now, where interest rates are starting to come down if they're not already at record lows. How's this likely to impact these two asset classes?
Well, I mean, you've seen it. Bonds have done fantastically well. I mean, I think there's a very good argument to be made that bonds are incredibly risky right now, globally speaking. I mean, across the world, yields are at remarkable lows, and I don't see sort of a whole lot of room for things to improve. It's interesting. You look at I think it's the 2-year Swiss bond right now is at a negative interest rate, so negative, I think, 0.5% on the 2-year Swiss bonds. So investors there have the pleasure of loaning the Swiss government, paying to loan the Swiss government money. That obviously has to do with concerns around the euro, but I mean, that's a very odd situation, and I think it speaks and is indicative of the type of extremes we're at in the market right now. And so I'd be very worried about investing in bonds for anything but sort of a longer period of time.
Yeah, I mean, you've got this massive sentiment overhang in the market at the moment. The one thing people are saying is, look, you know what? Equities are bad. Don't do business in the equity market because there's lots of volatility, and you know what? You could lose all your money because maybe global growth will never happen ever again. So sell your commodities and sell your resources, but put your money into bonds. And guess who's the most over-leveraged in the world? Is predominantly global governments. And exclude kind of the emerging market set out of that. It's the global governments that are massively over-indebted. And then you go and you buy their bonds, and then in real terms, you're in negative space. that means you're in essence making absolutely no money and you're standing still. And as a matter of fact, if you look at it from an emerging market perspective, most of our investors sit with 6, 7, and 8 even % inflation rates. And if you look up in Africa, people are sitting with far more elevated inflation rates. You buy global government bonds or just global bonds generally, you're just not making any money for these things at the moment.
Okay, then in the equity space right now, your thoughts on the property sector, because it has outperformed, it has continued to deliver returns. What is going to happen to the property sector in light of the fact that value investments is the value of the properties aren't actually increasing substantially?
Well, I guess property is a kind of proxy between bonds and equity in terms of its risk profile. But we have to look at these kind of returns on a risk-adjusted basis. So investors are wanting some kind of return that's stable, and they are trying to avoid. So it's more of a risk appetite issue than a return issue, why they're liking bonds and property. And that's going to continue until their risk appetite changes. Certainly, the second half of this year, we're not seeing any exciting reasons why equity should run. So we in our asset allocation would prefer bonds and property again for the latter half of this year. We've just seen a rate cut by the central bank, so that's going to be a kind of quantitative easing coming into the system as well, which should support property and bonds at least in the interim.
Yeah, I mean, you can find value. The question is this the right price to pay right now? Because quite frankly, who knows? You don't know what the latter part of the 6 months will go. The Eurozone crisis has kind of gone a little bit more back burner. Little skirmishes happening in Spain, protests here and there and so on. But I mean, it's literally gone a little bit back onto the back burner. Now the question is, and you can see the market's trying to recover, but at what point does it go front burner again? And those are kind of some of the big things to take into consideration.
David, it's interesting when you look at the returns from a longer term perspective, because the property sector, real estate sector delivering 21.9% over a 10-year period, and value investors on the domestic equity front delivering around 20%, so not far behind that. So when we take a step back and we kind of look at this from that longer term view, what are your thoughts on getting into that value space?
I mean, I think South African market sort of isn't perfectly obviously correlated with what's going on with a lot of the developed markets, and so it's I think outperformed a lot of the other developed markets in recent years, and so you do have to worry about it being able to sustain that type of pace. I don't know that I'd be expecting 20% annualized returns. That said, out of that, the property return there is a little more scary, because theoretically, property is a lower should have sort of lower risk associated with it, so you should expect lower returns, and the fact that it's outperformed stocks in that regard is somewhat concerning and might speak to the lofty valuations. But in any case, I think your best bet is to just buy and hold, and if you have the proper time horizon, then don't second guess yourself. You need a longer term time horizon if you're going to be buying property and equities, as opposed to money market or short term bonds. And so buy it, find a good fund manager, since we're dealing with funds here, and have faith in them. Let them make the decisions for you, unless you want to do it yourself. But I think this is what sort of gets lost in the ETF or index versus mutual fund debate. Is it's hard if you buy an index and you're sort of trying to time and buy in and out. It's hard to make that timing and get that timing right. So you're better off just to sort of find your appropriate asset allocation and stick with it and let the managers do their work.
Well, let's hit pause on this. We've laid the foundation. Now time to get into the juicy bits and see who were the best performing fund managers for the first half of the year. When we come back, we'll be delving into more research and findings from Q2, and of course take a look at the research that Morningstar South Africa has produced. We'll see you in a bit.